The other important set of numbers that came in yesterday were, not yesterday, sorry, that came in the past week were from DLF. We couldn't get to speak to the management then, but they join us now. Ashok Tyagi, the Group CFO of DLF, joins in. Mr. Tyagi, good morning. Thank you very much for joining us. First up, if you can take us through just the debt position. You had committed that you would be bringing down your debt, and from what you had promised, there's another 2,000 crores that you have to bring your debt down by. Can you enlighten us about any plans? Do you still stick to that target, and we will see your debt down by another 2,000 crores before the year is out?
Okay, so Lata, we began the year with a net debt of 21,700 crores. And we are at 19,500 as of September end. Basically, we did the two major actions that have helped the debt come down in the last 6 months have been the IPP and the disposal of the wind farm assets, along with some minor disposals. The next 2 months, the next 2 quarters, we are committed to stick to our 17,500 guidance. And the big event, hopefully, that should happen in the next quarter or two, is the disposal of the Aman, Aman resorts, which should get us down to that number. So we stay committed and focused on the 17,500 number that we have been guiding the market to.
Mr. Tyagi, good morning and thanks for being with us on the show. Apart from the disposal of Aman resorts, what are the other divestments or sale of assets that the company has lined up to meet that target?
So right now, because Aman is the bulk of that, so hopefully Aman, I don't think Aman is any longer a question of if, it's just a question of when does it consummate, and does it consummate this quarter or overflow into the next quarter. So we are very confident on that. Apart from that, there are smaller disposals that are anyway in the pipeline. So we have in principle signed up for the sale of our insurance business, which is pending IRDA approval. There are a couple of land parcels in geographies like Hyderabad, where the agreements have been signed, but those still need to be consummated. So in this entire sort of, what should I say, this bouquet of disposal that we have, we do not see a risk to 17,500 number at all.
Okay. What about the interest cost? Just to take that discussion forward, once you bring down your debt, what could the interest cost run rate drop to? Because this quarter as well, interest costs have gone to 600 crores plus, which is about 16-17% growth year on year.
Okay. So one thing, Sonia, is that our interest charge-off in P&L to the total interest ratio is almost running at 80%, which is, I think, clearly far higher than our peers, because most of the projects that have been, gradually hitting the commissioning stage, the interest is getting charged off to P&L. B, there has been a clear increase of interest rates by at least, more than 1% over the same period last year. And C, if you see, across the last 1 year, while our net debt has run down, we have not reduced our gross debt because of the fact that in these uncertain times, we would rather sit on liquidity than be found wanting for liquidity later on. So we clearly want always to have that we should have enough liquidity to at least service the next 6 to 9 months of mandatory payments. So our September balance sheet also has a 3,500 crores of total cash and cash equivalents on our balance sheet, which is the reason you will not see the interest run down immediately. But I do assume that beyond March, the interest should start coming off, with this entire 4,000 crores delta that we have. And the 4,000 crores delta should mean an annual interest saving of about 450-425 crores.
Okay, now this is fresh news, Mr. Tyagi, which we got from the Reserve Bank yesterday, that they are going to allow options on equity participation from abroad. The only thing that the Reserve Bank, which has traditionally been their position, they don't want to make it look like a definite return on, a fixed return on their equity. Otherwise, they are open to put and call options on equity. I understand that notification will come from the government in a day or two. If that happens, and now that it is imminent, I have a positive confirmation on that, will you be looking at some kind of capital infusion or any kind of using this route?
Honestly, given the RBI's past position on the put and call, this is a very welcome development that, that they are agreeing to this. Frankly, we in our business haven't, apart from some PE investments that we took about 4 or 5 years back, we haven't looked at project-specific PEs, But once the notifications come out, we'll clearly look at that if there are specific projects where we are open to this. But right now, honestly, Lata, I haven't looked at this with any degree of seriousness so far.
Okay. Now coming to sales, I think you all achieved in the first half of what you all have targeted for the full year, 3,000 crores plus something. You will do 6,000 crores, or would you want to better your guidance?
No. We are not bettering our guidance. We are not worsening our guidance. We should do 6,000 crores. Our last year, full year sale was 3,800 crores. Against which we have done 3,200 in the first half itself. We have, taken stock of all our potential launches and the material available in our existing launches, and we feel pretty good that we should be able to complete the 6,000 crores mark by March. If you are saying would we better it, maybe by a small bit, or but I don't think 6,000 is the number which we right now stand with.
Okay, some analysts are actually concerned that you may not be able to meet the 6,000 crore target because a majority chunk of your sales will come in from the Gurgaon market, and channel checks have indicated that demand in Gurgaon has dried up a tad bit and there's an expectation of a fall in prices. Are you worried about that?
So, Sonia, obviously, I respect those analysts who are saying that, but they've been saying that for the last 1 year, and we have sold Skycoat, we have sold Ultima, we have sold Crest, we have launched Camellias, but I respect that. So, obviously, does it mean that we need to be more cautious about the market? The answer is a clear yes, but we right now still believe that given the the locations that we have and hopefully the credibility that we have built up, we should still be able to meet this guidance.
Okay, just one last question from my end then. This time around in this quarter, your margins at 30% have been the lowest margins the company has ever clocked in. Can you just give us an indication whether the margin pressures will continue for the second half of the year, or do you hope to get back to that 35-39% levels?
Okay, so Sonia, our secular margin guidance actually has always been somewhere in the mid-40s. And this quarter, I think we landed up at 36 or 37%. The book margins will continue to be under pressure for the next 3 to 4 quarters, basically because all the older projects, which were traditionally, the lower margin projects, are coming up for closure. In fact, many of them are now gradually moving off the balance sheet. And the newer projects are not hitting the revenue recognition threshold on account of the new accounting policy. So as of today, like I am sitting on almost 1,400 crores of potential profit margins on the project that I have launched since December, which has not hit the revenue recognition threshold. So as they start hitting the threshold in the next 3 to 4 quarters, you will see the margins revert back to that 40+ percentage point that we believe is the right margin for our business.
On that positive note, Ashok Tyagi, we appreciate you taking time out for us, sir. Thank you very much for joining in.